which means the losing side is one credit spread. So this is where what we've learned in the previous modules become important, because you have to adjust either the bear call spread or the bull put spread. You don't have to adjust both. And therefore, margins are also favorable in this kind of a strategy, because the broker knows that you can't lose on both the positions. So they'll hold margin only for one position. So you can use your capital a little better, a little more efficiently with a strategy like the iron condor. So since you can lose only on one side, when we need to adjust that losing side, or at least the side that is getting hurt. And bear in mind, the other side will be making money. So let's take a look at what the iron condor looks like. And this is what an iron condor looks like. So let's say we were talking about Apple, that example that we just used. Apple is currently at $600. And what we do is we put a bear call spread at 650. So this is a bear call spread. If you look at this spread, that will be a bear call spread at 650. So the bear call spread is a bearish strategy. So you'll have a negative delta from that position. And what this position generally means is that as long as Apple doesn't hit 650 before expiry, this position will make money primarily from time decay. But this position will also make money if Apple goes down, because it's a bearish strategy. On the other hand, the bull put strategy is a bullish strategy, but it's also a time decay strategy, because you're selling both of these options, you're selling these credit spreads. So the bull put will make money if Apple goes up or from time decay. So the effects of the bull put are getting evened out by the effects of the bear call. So this is what we call a delta neutral strategy. So if Apple is 600, we can construct two spreads, one much higher than Apple's current price and one much lower than Apple's current price. So these two spreads tend to even out each other, and you start off with a delta neutral position. And even if Apple goes a little bit on either side, it doesn't matter. It's only when Apple goes too far on one side, then that side is going to get hurt. So if Apple moves towards the 550 strike price, then we have to worry about the bull put. And if Apple goes too far towards the 650, then we have to worry about the bear call. But when we are worrying about the bear call, remember the bull put is going to be making money. So this is a very interesting strategy. It's actually one of the favorites of all traders, including myself. I love the iron condor. And there are things that we have to watch out for in the iron condor. One of the big negatives is that it's a pretty high negative vega position, because we're selling two credit spreads. So even if we just sell one credit spread, we become negative vega. But now we are selling two credit spreads. So we are double the negative vega. So if you look at this, the volatility becomes an important consideration. If volatility increases significantly, then your